Hello and welcome to the market update from 1st to 6th of September 2024. So let's start with our usual, the world economy. China came out with their official manufacturing purchasing managers index number, PMI number. It slipped to a lower than expected at 49.1%, 49.1 in the month of August from 49.4% in the month of July. So we were witnessing a contraction in the manufacturing activity of the China, still continuing, and it's still at a level lower than the last month. Japan, news coming in from Japan. Most of the market participants anticipate that the Bank of Japan will raise interest rates further this year. So there could be another chance of a carry trade that we had witnessed in last month could be happening again, where the market would fall. The whole week, this whole week was concentrated on one data point, and that was from the US. From the US Labor Department, the data was that the first they came out with that there are a few job openings in the month of July at 7.7 million open jobs from 7.9 million in the month of June. This data was for the month of August. For the month of July, sorry. US, the main data point that everyone was looking for was the US non-farm payrolls, which rose by 142,000 jobs in August, but there was a consensus estimate that it should be around 160,000. The unemployment rate had ticked lower from 4.3%. It has gone down to 4.2%. But the average hourly earning also rose by 0.4%. So this was a major data that everyone was looking at. There was an impact on which has caused markets to be cautious in all over the world. That if this data doesn't come out well, then there could be two possibilities. One possibility is that the recession, the US economy could be going into recession, and the second is the Fed rate cut, which depended on this data. So we are seeing that this data is definitely showing that there is a weakness in the economy. Now, how the Fed would react to this data is to be seen, but definitely we could see a rate cut coming in the US markets. But the markets are factoring in a rate cut of about 0.5%. If that is not achieved, we could be seeing this going at 0.25%. Then there could be some issues in the overall economy, overall markets. As the data was not strong, the US people feared recession. The US 10-year Treasury bond yields started to decline as the demand for the US bond yields again started to rise. So bond yields fell to 3.7 in this week. As said, there was weakness in the market pertaining to this data. The markets all over the world showed weaknesses. Dow Jones corrected by 2.93%, S&P 500 corrected by 4%, Nasdaq corrected by 6.7%. There was another reason that all the boom that we had seen currently in the last 1 year in the US market was led by the more of the technological stocks, where the AI boom was being projected as the next big thing. And now now Nvidia, the biggest stock in this segment, is projecting a weaker earning growth for the next few years. So we are definitely seeing a slowdown in that movement, and that's why the markets are the two factors. One is definitely the USA going into a recession and the fear of a recession, and of course the tech stocks not giving up a good result. Is that we are seeing this result out right now, that the markets are correcting. The European market was also weak, in line with the US markets, with waiting for this data, which is now out. The Asian markets were also negative, with the same in line with the US market. India came out with its PMI number. India's manufacturing PMI number came close to 57.5, which was lowest in the 3 months period. But the thing to know that is that it's still in a expansion zone. It's not still not gone below the 50 points average. The service index continues to rise at 60.9, higher from the last month of 60.3. Again in the expansion zone. So the number does the manufacturing activity does looks down by some point, but definitely in an expansion, so not in a contraction. India also came out. India's forex reserves has also risen by $2 billion to hit a fresh record of $884 billion. Volume was up over by $60 billion YTD in this year. Indian rupee closed at a record low of 83.9 against the dollar at 83.98 against the dollar. This weakness was again attributed to the volatility in the bond market, in the US markets, were causing the weakness in the rupee. If we look at the oil prices came down by 9.33% at 71.47% dollar. This was because there was expectation that the OPEC plus countries would increase their oil output in the month of October, but the supply side has been weakened. The major oil buying countries of US and the China are currently facing issues in respect to buying oil. But towards the end of the week, we saw that there was news that OPEC has postponed this production to the to November or December. So next week, the oil price might go up from this level. Gold, we saw that the gold prices corrected by 0.24%. It was traded at $71,460 a barrel. If we look at the FIIs and DIIs for this week, as I discussed in the last week, that the equation was very conducive for FIIs to buy stocks in India. FIIs started with this week in the buying position, but towards the end of the week, because of the recession fears, they started at selling the Indian stocks. So overall net result of the week was that FIIs bought 1,400 crores worth of equity, whereas DIIs bought 5,545 crore worth of equity. For the next week, the situation seems to be we are seeing that the oil prices and the point prices are favoring Indian equity by the FIIs, but definitely the recession fears and the rate cut would have a larger play into this. So overall impact on the market was that Indian market was also negative, in line with the world market. The Sensex fell by 1.4 to 1.5%. Nifty Bank was down by 1.5%. Nifty Mid Cap was down by 1.3%. So as a result of it, if we look at the valuation, Nifty 50 trailing PE reached 23.1, a bit lower from the last week's PE. But still above 2 years and 5 years average. Nifty Mid Cap 150 trailing P is at 43.8, still above 2 years and 5 years average. Highly costly to look at. Nifty Small Cap 100 trailing P is at 30.2, nearly 2 years and above 5 years high. Again, a costly thing to look at. If you look at the Buffet indicator, which shows the total market cap to GDP, we are currently still at 107.91%, which shows that the indicator is showing that the markets are still modestly overvalued. If we move to the Indian bond markets, 10 years government bonds are trading at 6.968% yield. If we look at the yield curve in the short term and the long term are flattish, but in the medium term they had turned inverted. So there's a bit of a risk that the markets are showing in the